Thanks very much. Yeah, I've started leaning into the short videos, Instagram Reels. It's fun. It's fun to try and reach a different audience with snippets of information, just trying to increase awareness of the importance of mining in our world and our economy for a bunch of younger investors who often haven't really considered it as an option. So that's what Instagram is about. If you like short videos, I'm on there many times a week. So thanks for mentioning that. What I want to talk about today is how to build a junior mining portfolio for this year. So I'll just jump right into it. The premise of this building of a portfolio is that metals are not one thing. And if you're here at this event, I'm sure you're aware of this, but it's really important to put that into action. Not just be aware that gold moves differently than copper, moves differently than uranium, moves differently than lithium, but to actually structure your portfolio around that, or at least structure your expectations for the stocks in your portfolio around that. So I just threw together a 5-year chart of uranium, copper, and gold. There's some correlation in those prices, but there's also a lot of discord in those prices and how they move. And that all of those moves are made sense for particular reasons at particular times. So metals and mining stocks, or metals are not one thing, and metals projects are not one thing. Different projects, different project stages make for different investment theses. So you really have to meld those two concepts together. What is the metal doing? What's the project stage? What's the market up to? What's the investor sentiment? And that, I think, is really important in creating a portfolio where you have reasonable expectations for when things are likely to perform within that portfolio. So that's it. What metals do you believe in, and on what time frames? Because this determines what kinds of stocks to buy within each of those. So I'll go through some of the metals, and then I'll talk about which stocks, therefore, I am buying for each of those metals based on what I think is happening or going to happen with those metals. So uranium, no surprise to anyone for me to say, it's happening right now. I love uranium as a bit of a case study for metals investors because uranium spent 6 years from 2016 to 2022 working through excess supply, right? The spot market was oversupplied. It was sloshing around. You couldn't get any momentum in the uranium spot price. There was like a bullish event here, a bullish event there, but you just had to churn through all kinds of excess supply on the spot market. But that happened. It took 6 years, but it happened. And now there is not excess supply in the spot market, okay? That is why the spot price has doubled in the last 8 months alone. And importantly, with the spot price of uranium, this isn't a speculator's price. This is an average of transacted terms, two-party deals on a particular day. That's what there's no public market for uranium. It's just actual transacted deals. They have to report them to TradeTech and UXC, who then take averages, and that's what determines the spot price. That's what is the spot price. We had a big jump in uranium to start January for 2 reasons. And I mention them because they're important, but also because they capture the 2 factors that matter in uranium right now, which are the lack of supply and the East-West divide. So we don't have supply in the market, in the spot market, and Kazatomprom came out and said, oh, sorry, we're actually not going to make guidance this year, and they're not going to make guidance in 2025 either. They haven't said that, but they're not going to. That's not a surprise for anybody who follows uranium, but it still is dramatic because Kazatomprom is responsible for 40% of the world's production. Their cuts back in 2016 and 2017 helped right the market when it was drowning. Their return to full production was supposed to help fill the gap that we're now facing, and now that help has been delayed by several years because they can't get sulfuric acid and because they weren't putting enough money into building new wells, which you really need to do if you want to keep your production going at an in-situ recovery uranium mine. So that was a big impact on the supply side of things. The other big thing that's in the uranium market is the East-West divide. And also at the beginning of January, we got the next pledge of support for domestic nuclear energy from the US government, which was they pledged $500 million to help support the build out of fuel processing capacity. The whole East-West divide thing, right? America consumes 48 million pounds of uranium a year, biggest uranium market out there. China will get there pretty soon, but for now, America is the biggest uranium market out there. 2 years ago, they made 9,000 pounds. That's how many pounds of uranium America produced 2 years ago. Last year, it was 20 200,000 pounds, I think. Still, drop in the bucket relative to consumption of 48 million pounds. Now, about half of that 48 million pounds, absolutely, they source from non-US but friendly, you can call them sources, specifically Canada and Australia. And that's all well and good. But the other half comes through the port of St. Petersburg. Some of it is Russian uranium, a bit. A lot of it is Kazakh uranium that comes through the port of St. Petersburg. So when there's all this talk about no Russian imports of uranium, that's not just uranium that's produced in Russia, that's Kazakh uranium, because Putin controls whether that uranium leaves the port of St. Petersburg. So, huge thing that is literally bifurcating the market. Back in the Cold War era, we used to have two uranium spot prices. We had a free country spot price and we had an Eastern Bloc spot price. We are literally going back there. We are going to a situation where Russian Kazakh uranium is only going to go east to China and India, and then there's going to be Western uranium, if that's what it ends up being called, and there isn't enough of it. There isn't enough for either side of the market, but there especially isn't enough for the Western side of the market. So anytime you get a piece of news that reinforces either side of that, the lack of supply or the East-West divide, the investors who are somewhat hesitant because the nuclear sentiment hangover is a real thing, get yet another reason to erase their hesitation and be like, oh, this is a very fundamental market. This is not a speculation market. This is a fundamental market where we don't have uranium. And there isn't, America can, in time, start producing enough uranium for itself. It used to produce over 40 million pounds of uranium. And then guess what? The Cold War, we became friends with Russia, and everything shut down. And so you can gradually get back there, but it's going to take a long time. The easy restarts of that production are coming now, but that's going to sum total a few million pounds over the next few years. Far cry from what is needed. It will take the hard pounds to balance the market, but the hard pounds are the big new hard rock mines. And how easy is it to permit any big new hard rock mine? It's not. We know it takes a long time. Uranium is usually harder. This is the Cameco supply-demand gap chart. This is before Kazakhstan admitted that it will not meet guidance, although Cameco may have incorporated that because they obviously they knew ahead of time from their own assessment. But you can see, this is a very real situation. So if uranium's happening now, it is the market, it's happening now. I still see a lot of opportunity ahead in the uranium price. I think it's, if the bill passes in the Senate and America says no Russian uranium, except we'll offer these exemptions to utilities if they really can't get uranium, then we'll give them an exemption and they'll be allowed to buy Russian uranium for the next 5 years. That's the bill that's already passed through the House and is before the Senate right now. It's going to pass the Senate. They're just having a fight about something that's attached to the bill that has nothing to do with uranium. When that happens, I think the odds are pretty good that Putin says, oh, how about we just do that right now? And he cuts it off from the other side without exemptions. If that piece of news hits, I think the uranium price does a big jump, 140 bucks, like soon, right? I'm not going to say it will then stay at 140 bucks. Any market that's doubled in 8 months is going to have its ups and downs. But this market has staying power. There isn't an easy answer. The mines just aren't ready. The East-West divide is significant. And so you can, in a market that's this fundamental and has this much oomph in it, you can play across the spectrum. One thing that I think is really interesting is that pre-discovery explorers in the uranium space haven't really moved yet. The producers, the advanced projects have moved significantly, for sure, but the pre-discoveries haven't, which means the rising tide isn't yet lifting all boats. I think that will happen, so you can argue that there's likely some easy upside in the pre-discoveries as the market just decides to really flood into the space and starts lifting all of the boats. But the gimme is to just own growing US production and the best advanced projects, because those are what this market specifically needs to fix the problem that it's facing. So those are 3 examples. There are others. That's what I'm doing in uranium. Okay, gold. Haha. Gold has done a very impressive job over the last few years. even if that impressive job has made for a very boring share price chart, or a very boring price chart, right? Nobody gets excited about a sideways chart. And we've had a very sideways gold chart for quite a few years. Obviously, the big change is that now we are in a heading towards rate cuts environment. Absolutely fundamentally different for gold, that we are heading towards rate cuts. That gold managed to hold its ground despite all of the rate hikes is the thing that stands out so much. So now we have rate cuts coming. We still have all the central bank buying that was the reason gold held its ground so well. And the chart is bullish. All of those things add up and make me very opportunistic on gold. But I don't think it's going to happen tomorrow, because I think the next leg up will probably require market confidence in the time, like that the next rate cut is right actually here. And we kind of thought that it was, and now guess what? Traders are stepping those bets back a little bit. Fair enough. I don't know if the Fed is actually going to cut in March. Anyways, I think we have to wait for that, the certainty of the cut and the timing, and that will when that happens, whether through economic data that's weak enough that it gives people confidence that the Fed's going to be like, okay, now we have reason, we can do it, or whether it's just they want to get the cuts in before we get too close to the presidential election. Once there's news that the rate cut is coming, I think gold will make its leg higher. But since we don't know exactly when that's going to happen, the more cautious approach, rather than diving across the spectrum into gold stocks right now, is potentially to buy the ones that move first and most when gold makes its move. Because if gold breaks up through $2,100, it could well go well above. It could go nicely above that, right? Because that's a significant ceiling. So you can definitely own the stocks that move first and most when gold makes a big move like that. The producers, the building or close to building big new mines. Those are very rare assets these days after the doldrums that we've been in. And then you just have your list of explorers ready. And as soon as the market starts to go, then you can deploy into them. But it is a bit tough to deploy into them now and then be like, okay, is it next month? Is it 6 months from now? If we all had unlimited capital, then sure, buy them now. They're super cheap. But I am just being a little bit aware that we don't all have unlimited capital. And so I think it's just important to be aware that it might not happen tomorrow. I think gold will make a big move this year, but it might take a few months yet before that plays out. Copper, just pull that timeline out a little bit longer. Copper is a yes, in that the market will happen, and it will happen because we've had over a decade of very conservative management teams at major copper mining companies, at all major mining companies, disinterested markets, and ever harder permitting. And those three factors have pulled together to mean we haven't been building new copper mines. It's a really significant thing. We also haven't been finding big new copper deposits or pushing them towards development. And so, I mean, there's two charts here. One's supply demand, one's current reserves, I believe, in major discoveries. You can see that that's clearly trending down as you move through the decades. And I saw a really cool compilation of the top 40 copper development projects in the world, just a table over the holidays. And I loved the quote that came along with that, which is that 31 of those 40 are facing significant challenges. And if I limited that down to projects that could produce within 10 years, so pre-feasibility or feasibility stage projects, there were 23, 9 of them were blocked, not going anywhere. At this point, just take them off the list. And another 5 faced very significant permitting risk. So 14 of 23 were like, don't place too many bets on those. That's just a capture of the amount of challenge there is in bringing that copper supply on. But it's not going to happen tomorrow, or probably the day after. And my basis for the fundamental argument here is that investors buy commodities, in particular copper, which is the PhD of growth, right? When that's what they're positioning for, when they're positioning for global growth. They also will buy it when the supply gap is here and people can't buy copper today. That's what's moving uranium, right? Uranium's also a commodity. Nominally, it moves when people are positioning for growth, but oops, we ran out of uranium, so we better start investing in that now. I don't think we're going to get to that for copper tomorrow. I don't think we are going to get to a position where where the broad market is positioning for growth, or where people have trouble buying copper. Maybe not even this year. I said uranium worked through its slosh, its excess supply for 6 years. Copper's been working through its excess supply for a couple years already. But remember how many warehouses of copper there were that the Chinese were leveraging to have money in the housing market? That's the kind of excess supply that is working its way through the copper market. So we're not there yet. It's going to be a great market when it happens, but I don't know when that's going to be. Silver is a very similar argument to copper. I think of silver primarily as an industrial commodity. And we had a really significant deficit. It's always a tight market, often in deficit. The deficit's usually met with recycling. We had a much larger deficit than usual the last 3 years because of increased solar demand. Interestingly, you can hardly recycle anything from solar panels. So the recycling factor of copper that's consumed keeps falling because solar keeps growing and we can't get the silver back out of that. The other way that we managed the deficit in the past few years was dishoarding. ETFs and investors were just selling back their silver, but that pool doesn't last forever. It's kind of like that copper situation, right? We're working through the excess. And kind of like copper, we're not in a growth situation. COVID, recession, it diminished that focus on silver because it is really an industrial metal at this point. But when we return to growth, I think that focus will come right back and it will shine because copper sort of has that, or silver sort of has that appeal. So I think that has a very similar outlook, thought process, timeline as copper. Lithium's an interesting one, right? So looking back on this crazy price chart, in 2021 and 2022, the lithium price soared 700%. And that was because Chinese electric vehicle sales boomed. There were amazing subsidies, and so there was a huge surge in Chinese electric vehicle sales. Then in 2023, China did not renew those subsidies. And all of a sudden, a price that had gone too high was given a reason to correct. And correct it did, and it came all the way back down to where it had been prior, right? The interesting thing is that the chart on the bottom there that I borrowed from Marin shows that Chinese electric vehicle sales are at all-time highs. So the reason that it happened in the first place is still happening. And now America is really, is now doing the push. The official US target for electric vehicles is to increase market share from 5% to 50% by 2030. Crazy target. Lots of reasons that that's very, very unlikely. But nonetheless, that's the target. That's the push. That's the goal, right? And the subsidies for US electric vehicles say no Chinese lithium. If we were to get to 50% market share by 2030 and not include Chinese lithium, American production would have to increase 40-fold. I'm not saying that American production is going to increase 40-fold in the next 6 years, but I'm saying that the official targets are trying to push us in that kind of direction in terms of a scale of ramp up. So I think those growth metals, you don't necessarily need to have exposure to them today. There can be corporate reasons, stock-specific reasons, absolutely, that's different. But I think they're more of a global growth argument. And when we start to feel that investors are like, okay, we got through the storm, we're on the other side, we want to start positioning for growth, I think those are going to be three markets that are very worth positioning in. And just like I said with gold, you can start with the sort of the stocks that move first and most when a market goes, the producers, the big advanced assets, and then you can move down. This is just examples of what happened to the big copper producers, the biggest ones in the last copper market, right? 10x in the biggest copper miners. So when it happens, it can happen in a great way. Now, I just went through all this timing and patterns and leverage and outlook and all of that. And then there's the exception to the rule, which is explorers. Because discoveries can move a stock in a phenomenal way in any market, right? So if you are someone who plays the exploration side of the game, throw everything that I just said out the window and you can buy the stock based on corporate reasons, right? What you think the investment thesis is for that stock. This is something that I talk about a lot in my newsletter. I own a lot of explorers and I explain what my thesis is for each. And then I reassess that thesis every time there is a news release because it's likely to impact that thesis. If you are going to bet on discovery, my very condensed list of things to consider, because they are the hardest. Pre-discovery stocks are very hard to pick. It's easy to look at a map that has beautiful colors on it and it looks like it has a bullseye. There's obviously a lot more to it than that. So own quite a few. Don't put all your eggs in one basket because actual success rate not what we wish it was, not through the fault of the explorers. That's just the nature of trying to find things that you cannot see. If you can buy in financings with warrants, warrants will help you increase your exposure should it go really well. Be aware of low trading volumes, although if it goes really well, the trading volumes will spike and you'll be fine. And I do encourage to take some profits if you get a great price spike on a discovery, because it's rare to regret selling in the markets these days. And then just manage your portfolio. Know why you own each stock. And if news changes that reason, make sure you either come up with a new reason or exit your position. Thanks very much. I write newsletters. Come and find me. Thanks.